I thought it might be a good idea to do a quarter in review of some of the biggest covered call ETFs that have now begun trading or will start trading fairly soon, along with some of the biggest, most notable distribution changes from a variety of covered call ETFs. So buckle up, we're also going to talk about tariffs towards the end of this video, especially as that is no doubt causing heartburn in the community. How should we deal with this, if anything at all? What am I doing? Well, let's get to it right now. Before we get to the latest and greatest funds that are brand new in Q1 of 2025, let's also talk about some of the more notable distribution changes from three Canadian covered call ETF fund managers. So the first one we're going to highlight is BMO ETFs. Now, they are more known to be very conservative. Their yields don't typically touch 10%. I want to say maybe a couple years ago, ZWK got up above 10% during that banking crisis that we saw in March of 2023. There might have been some opportunities there, but since 2024 and interest rates coming down, anything financials related, the price appreciation took off, which then started to bring those yields down, at least in the financial sector. But awesome to see that, which I don't typically see, don't normally highlight, but some of these funds have gotten some outsized increases. We got ZWH, the BMO US High Dividend Covered Call ETF, along with its US dollar counterpart, which is ZWH.U with 30% and 19%. And then we got ZWS, the US High Dividend Covered Call hedged to the Canadian dollar at 16%. And ZWT, a technology covered call ETF, almost 50%. Now you might be thinking, surely with a 50% raise, or almost 50%, that should get a fund like this over the 10% threshold. Nope, it's going to be somewhere in that 5 to 6% range. So nonetheless, good to see that, BMO is, they don't often raise their distributions. I can't even remember the last time I've even reported a distribution increase from BMO. Now, they are known as, I would say, the AUM kings of Canada when it comes to their covered call ETF lineup. They have multiple billion-dollar funds like ZWC, ZWH. ZWB is probably the biggest covered call ETF in Canada at over $3 billion in AUM. And second place would be something like a ZWC or a ZWH. So anyway, they probably have 3 or 4 funds over $1 billion. But nonetheless, conservative approach to their lineup. So the next up is Evolve ETFs. Now, I think this was certainly a question in the community for a while. You could kind of see it percolating in the various communities, especially when it came to ESPX and ETSX, looking for notable changes there. They finally came. ESPX and ETSX are now over 10% for their forward-looking yield. They were probably hovering somewhere between 7-8%. Before the distribution increase. So if you are an ESPX or an ETSX holder, no doubt you're loving that news. Another notable change is with Lead and its various other counterparts at a 50% distribution increase. The Evolve Future Leadership Fund at 50%. So I can't think of a time when that when this fund had actually when it's been raised before, but definitely nothing in the recent past. Going all the way back to when the tracker first came out. Can't think of it. Going down the list, we get into some territory where we got some good news and then we got some lackluster news when it comes to the Global X lineup. Now, similar to BMO, the Global X doesn't really raise or cut their distributions almost ever. Again, it's very rare that these guys do it, but between January and February, that's what they did. And we can see financials got a little bit of a cut. The diversified Canadian Basically, the TSX 60, their version of that fund with leverage, got a 10% cut. What else got a cut? The developed markets CoveredCall ETF, along with the its enhanced version, got a little bit of a cut. Along with ENCC and ENCL, got cuts, but where there has been a bit of a pullback, there is also some victories to talk about as well. And those are going to be funds like USCL and QQCL, respectfully, where USCL getting almost a 10% or 11% raise, and QQCL getting a commanding 18% raise, along with QQCC getting almost 10%. Even that gold CoveredCall ETF, it's like a direct exposure to gold. Even that got a 20% jump. One fund that's in my portfolio, great to see, EQCL, which is very similar to XEQT, right, where it is invested in different global geographies. We are going to talk about a little bit about QQ or EQCL a little bit later in the video, because I just wanted to highlight something that's really strategic and something that I just noticed that Global X has done with EQCL that I didn't really realize this before, but I'm going to save that kind of towards the back end of the video. So anyway, we got some great highlights from BMO, Evolve, and obviously Global X. They're kind of all over the map with the cuts and the raises. Some of it probably needed, and others certainly warranted, especially with the growth of QQCL and USCL, respectfully. By the way, if you are someone who's new to CoveredCall ETFs, income investing, this channel in general, you're wondering kind of what is this data that I'm looking at? For those who are regular viewers, you know the spiel. I talk about it all the time, but I do truly believe this is the best tool that you can possibly get out there. This is the CoveredCall ETF AllStar tracker. I've been running this with updates every single month for the last what would that be, 15 months, ever since January of 2024. You got everything down here. You got tabs from tax data. You get, what we were just looking at here with distribution history, seeing how consistent some funds are. You get the various volume changes from the various CoveredCall ETFs on the Canadian landscape and the US landscape as well. You can track my portfolio, the various trades. You can filter through all this. Like if you really wanted to see how much I'm contributing, how much I'm receiving in distributions, you can follow me there. Even the various resources, videos that teach you how the CoveredCall ETF AllStar tracker works. And then the main page where there's performance data, and of course the yields as well for Canada and the US. So if you're interested in the CoveredCall ETF AllStar tracker, there's going to be a link in the description below. It's just going to take you right here. All you got to do, there's only a couple buttons you got to push, is the 31st. That'll take you, don't worry about the time. That's just the method of getting you the link so that you can access it. So just information, email, it's $50. That's a special I'm running, 50% off for the entire month of March of 2025 as the channel turns 2 years old. You fill in your credit card data. I don't see that at all. By the way, I always say that I don't want to see I don't want to see any of that information. Wouldn't even know what to do with it. There have been so many of you that are now participating in this 1 year email membership where you'll get a brand new tracker every single month on the first of every single month. And next month is a big update. We are going to be compiling all of the 2024 Canadian T3 tax factor summaries, and we're going to do a full-on comparison between 2023 taxes and 2024 taxes and give a complete rundown on some of the most efficient tax-friendly funds that are possibly out there. So if you want this for yourself, pick it up, and no doubt it'll expand your knowledge potentially a lot quicker than just simply, going through different single tabs, and it's all in one place, and it's meant for it to be easy. So we've talked about distribution changes. You got the CoveredCall ETF spiel. Now let's get into some of the latest funds that have hit the investment landscape here in 2025. And we'll go through some Canadian stuff, some American stuff. But the first one that we're going to talk about is Purpose Investments, where they have added some single stock ETFs. And now this news came out in January, where they decided to launch a bunch of single stock ETFs from Costco, Palantir, United Health, JP Morgan, Coinbase, Netflix, Broadcom, and a Magnificent Seven CoveredCall ETF. Right? It's sort of their kind of their first all-in-one with these single stocks. The next closest would be, as far as single stock and all-in-one single stock CoveredCall ETF, is by Harvest ETFs. We're going to get to them in a moment here. But that would be the next closest with HHIS. Purpose releases these, but you got to keep in mind that in late 2024, Harvest had launched their income shares, high income shares, CoveredCall single stock CoveredCall ETFs. And so then Purpose, in my mind, maybe they were already working on it, I'm sure they were, then releases this as a bit of a, well, we should build out our own lineup that has been around for a while. So they release these funds. Okay, next up is, well, let's just talk about some YieldMax stuff, because they have been releasing stuff all over the place from January, February, March. It's kind of interlaced between some of the Purpose and the Harvest releases. So, which, by the way, some of the most notable stuff is this like Target 12. I think more of them are coming. So Biggie, which is focusing on 12% yields with the biggest 50 companies in the U.S. Of course, you got Soxy for semiconductors. You got this Dorsey Wright strategies. What I actually like about these two, basically they each focus on 5 companies. So I can't remember exactly which one. Maybe it was Feet, where it's 100% on it's like 100% coverage on the entire portfolio with the 5 companies, which is, what do we got here? Meta, Bitcoin ETF, Netflix, Coinbase, and Tesla. So this is the 100% one, where they're running 100% options on those 5 companies. Okay, now YieldMax has gone and done something really unique here, where if we go to 5e, it's the same 5 companies, but check this out, and it's also 100%. Well, it's 100% on those 5 companies as well. But just wait a minute. They also include those same 5 companies yet again, but there's no CoveredCall options on them. So you can almost think of this portfolio like it has 50% coverage. That's how you could. But they own Coinbase, say, twice. They own Netflix twice. The ProShares Bitcoin ETF twice. So half the portfolio on these very volatile companies, with some of them have exposure to the Bitcoin landscape, some of them are directly exposed to Bitcoin. Those will be unbound. You'll see the growth, and then the other 50% is you got the call option writing. So think of it this way. One, which is Feet, has 100% coverage on the entire portfolio. This one is a basically 50% coverage, but again, kind of unique in the sense that they own each company twice, or they own the ETF twice. So that's kind of interesting, which, by the way, I got a couple of interviews lined up, and I'm going to be talking to Jay from YieldMax. I'm sure you've seen him all around on all the various income investing related channels. So I'll get to talk to him about the Target 12, along with the Dorsey Wright strategies, and obviously their most recent additions, which are the RDTY, XDTY, QDTY, which are those index-based YieldMax CoveredCall ETFs. And then, of course, I got Cy coming back to the channel from Tap Alpha. We're going to talk about T-SPY. We hit it off pretty good in our last 50-minute interview, which was back, I want to say, I can't remember exactly. It was either August or September of last year, and or maybe it was actually October. Never mind. And anyway, Jay's coming back on, or Sai's coming back on to chat about T-SPY and the evolution of Tap Alpha, and we have just a whole slew of things we're going to be talking about. So that's going to be the next video after this one. And just be sure to throw down in the comments if you got questions for Sai from Tap Alpha. Throw it down in the comments. I'll be sure to ask those questions along with Jay as well when it comes to these different funds. But these are the ones, at least for Jay, that I wanted to highlight: the Dorsey Wright, the Target 12, and the various, like I said, our DTY, XDTY, and yeah, the 0 DTE lineup. So you can see it there. Oh, my bad. SDT, QDT, RDTY. Ooh, I'm getting all mixed up with, right? I'm thinking of like Round Hill Investments, right? XDTE, right? It's so ingrained in me now, but they all kind of sound similar. But anyway, it's their 0 DTE options index strategies. That's what we're going to talk about. We probably should have led off with this launch, actually, since it was around January 16th. But oh well, that's all good. So Harvest ETFs, they decided to add to their lineup with the success of the 4 high income share cover call ETFs, single stock cover call ETFs that they launched at the end of 2024 to fill out that lineup even more so with MicroStrategy's, Coinbase, Palantir, Tesla, Meta. And they also introduced HHIS, which is undoubtedly, it's a community favorite. Maybe there is a little bit of heartburn around HHIS just because of the kind of performance the market has been experiencing in February and even now into April. It kind of feels like we're being whipsawed. There's been days in my portfolio where it has just shot up, and the next day all those gains from the day before have lost. I think many of you have experienced that. And anyway, so HHIS, a lot of chat around this one. I would still say it's a community favorite regardless of performance at the moment. Again, HHIS, please understand what you're getting into. During the good times, this is like pure unadulterated adrenaline rocket fuel, but this thing is going to be an anchor in your portfolio in slow times where we see market pullback. So something to expect from a highly concentrated fund that will have a max of something like 15 to 20 stocks in it, single stock ETFs, that is. And it's got leverage, which is good to see. And a lot of these, especially if they say enhanced, have that 25% leverage. You'll notice here with MicroStrategies and Coinbase that they don't, but they have just launched an enhanced version of MicroStrategies and Coinbase. So at the time of this release, back on January 16th, I guess they couldn't get approval for it for whatever reason. But as of now, that there is a leverage version of these single stock ETFs. And again, this is another recent addition as of like just a couple of days ago from making this video. They've also decided to launch a cover call Bitcoin ETF, which is HBIX, and they've also launched a Harvest Bitcoin Leaders Enhanced Income ETF. And both are leveraged at 25%, which is, up here in Canada, that is just sort of an industry standard at this point. I want leverage. A lot of the community likes having that 25% leverage. It's just a nice, call it addition to all of these strategies, especially since we want ideally hold these for the long term. Leverage is your friend in the long term, not necessarily in short term, because you never know what the market is going to do to you. But long term markets, ideally, hopefully, they keep going up. We don't see some Japan style performance where it peaks in like 1989 and then it doesn't eclipse that for 30 years. But anyway, Harvest Bitcoin Leaders, this one's pretty interesting. Of the two, I'm not really interested in the Bitcoin one, but the Bitcoin Leaders one, I kind of like the idea of having exposure to maybe the companies that are involved in Bitcoin or crypto in general, especially if they're elevating the technologies that might be associated with maybe technologies that we'll eventually interact with. Now, so for me personally, many of you know, I don't really care about Bitcoin, but the technologies, things that we might interact with that maybe harness Bitcoin, I mean, maybe there's something there. So I got definitely more interest in the Bitcoin Leaders Enhanced Income ETF. So anyway, that was as of a couple of days ago. They've also launched as of March 5th a bunch of new single stock cover call ETFs from Alphabet, AMD, Broadcom, Coinbase, Costco, MicroStrategy. That's what I told you. This is where the enhanced MicroStrategy launches right here. And along with, where's Coinbase? Right here, enhanced as well. So they finally got the approvals for those two. Those are no doubt, all of this is going to be stuffed inside of HHIS. So you'll probably have, again, I would say, off the top of my head, 15, 17 companies within HHIS. So you get certainly a lot more diversification, but the name of the game is the big companies. They're also quite volatile companies. So they move the needle when it comes to quick growth. And anyway, so HHIS is certainly, for me, is an interesting fund to follow. As single stock ETFs, I'm not in that game, but a diversified fund of a concentrated, volatile, growth-oriented stocks. I'm certainly interested, like I've said before in other videos. I'll probably give HHIS some time to sort of mature before I hop into some aspect. I have a couple of strategies that I might undertake, whether it be in my wife's spousal RSP or in a cash account or a taxable account that where it will be a much smaller proportion, but I'll use it more as a yield booster if I was to do that. So still just watching it closely. Some good opportunities with HHIS as it is 20% down off of its all-time high, which wasn't that long ago, as this thing is just a month and a half old, or maybe around that month and a half to 2 months old. Okay, so if you were waiting for me to talk about EQCL in this video more specifically, there is something that I wanted to share with you guys. Maybe some of you will find that this is like duh, but if not, then this is what makes EQCL a formidable addition to any fund. This is a geographically oriented cover call ETF by Global X, and they have done a fantastic job in constructing this fund. I have been waiting for a global cover call ETF that wasn't just US based and just wasn't Canadian based, that it did give you exposure to a batch of indexes that were outside of North America, which you get with this developed markets cover call ETF, and then this one down here, emerging markets cover call ETF. This is also a newer fund, the Russell index. They also have the NASDAQ 100, the S&P 500, and then the TSX 60. What I like about this is it just invests in indexes. It is one of the more simpler strategies actually out there. And I actually really appreciate that simplicity, where it is just writing a call option on the index. There is no stock picking involved, but it's just how they use that proportion. Like you can see the weightings here. Now, since all the tariffs and have been whipsawing back and forth, Trump not sure exactly. It said one thing one day, and then the next day he's relenting on the promise to bring. There's been pauses, exemptions. There's been fighting with Trudeau, calls with. It's just one big giant mess with the whole tariff stuff, and it is clearly causing a lot of chaos in the markets right now, as uncertainty breeds. Well, it breeds a very lackluster scenario. So the market's down because the market doesn't know where to go right now. It doesn't know how to adjust from all of this whipsawing back and forth. So that's why you're seeing the declines. It's a manufactured decline. Take all that stuff away, the market's going to recover. There have been indications, whether you believe it or not, from people from the Fed chair, Jerome Powell, who has just recently come out and said that the Federal Reserve is not going to act on interest rate increases or decreases until they have a better understanding of what the tariff plan is going to be. But anyway, with EQCL, something I really like about it is the U.S. has actually been experiencing some capital flight just because of the tariff stuff. And one spot in particular that has actually been doing really well is actually the developed markets. A lot of Europe's actually seeing some good inflows of capital just because it's just a way to protect money, especially when markets are uncertain. And so what I like about EQCL is that it can change its weightings based on what's going on in the market, right? I mean, this is the second biggest position besides the S&P 500 at 33%. And now I can't remember the last time it was at 33%, but anyway, it's capitalizing on that strength where money is now flowing into, which is into Europe at the moment. Canada is, I want to say that's kind of more or less been the same. I get it. Some of these other indexes get a smaller proportion, but that's what makes EQCL a very formidable piece of a portfolio, is that if America is not doing as great or there's uncertainty, with a fund like EQCL, GlobalX is going to rebalance it in a way to favor those other markets, or whether it's Canada, whether it's Europe, whether it's the emerging markets where that growth is maybe starting to take hold, and you're seeing a lot of it. I mean, EBNK, that European banks CoveredCall ETF by Evolve ETFs, has seen something like a total return of 20% so far year to date, and we're only 9-10 weeks into the year. That is in a nutshell what's kind of going on with the tariff stuff. European, a lot of money flowing into, and that's an easy exposure, European banks. So anyway, that's a good single example of why Europe is seeing these inflows that it's been seeing. By the way, if you are someone who needs help with understanding the CoveredCall ETF landscape and want to relate from one retail investor to another, then look no further than maybe heading down into the description below and then scheduling a one-on-one with me to help navigate. Maybe that's the CoveredCall ETF AllStar tracker. Maybe it's to help you learn how to become a better income investor for yourself. It's really not about me telling you what to do, because I don't want to do that. I'm not a financial advisor, a planner, none of that. I've never worked in that industry, but I've invested in these funds for 3 years. You pick up a thing or two by actually investing and pouring your hopes, your dreams, your anxieties, your stresses into this kind of stuff. And there are no doubt some unique insights you can get from those that have gone through the roller coaster ride of any kind of investment, but in this case specifically with CoveredCall ETFs. Maybe you want to understand how I got into it, and how I've navigated the terrain of the different market cycles that we face every single year. But by all means, you book a session if you feel like you need that, and I'm more than happy to speak with any of you about these products, and just hopefully help instill confidence that these can be an option for the long run. So check it out. So before we ended the video, I also wanted to highlight the performance of my portfolio so far, as no doubt there is a lot of concern amongst the community about should you sell, should you divert course, what should you change? For me personally, I'm not changing anything. I have decided to invest in diversified funds. So for me, there's nothing else to do. It just wait. That's it. Collect income and just wait. So I mean, right now my total return is basically at par with the S&P 500. The Nasdaq's just taking a whooping right now. But again, with the tariff stuff, it's kind of self-manufactured. If they go away and we kind of go back to the way things were, things probably go back to the way they were. The reason for that is there's now market certainty if that's what comes to be. So there could be some great opportunities right now. Who knows how long this tariff stuff is going to last? The longer it goes on, and the more wavering there is, the more the market probably declines. But as soon as it stabilizes, whether tariffs are here to stay, whether they're not, as long as it stabilizes, you probably get some kind of bounce back of some sort. But I'm not going to here to promise that's a 5% bounce back, a 10% bounce back. Who knows what it's going to be? But again, it's about market certainty. I remember I was like walking by someone at work and they were asking me, "Have you seen the market today?" I'm like, this was in the afternoon. I'm like, honestly, I have not even thought about my portfolio today. I'll check maybe a couple times a day. But other than that, honestly, I don't think about it. And that's kind of the beauty of just investing in the diversified stuff. And you know that it's just a long-term strategy. I'm not playing the different trends, the different market cycles. I'm just investing in the entire economy, and that whole economy ideally just takes care of me. The other part of any kind of pullback of sorts is that, yes, depending on how long it goes, can covered call ETFs reduce their distributions? Absolutely, they certainly can. But will these drops be as comparable to the price drops we're seeing just sort of across the board? I mean, that's just something to think about and to compare yourselves. I'll compare, or at least give you some, hopefully it's some food for thought, but just keep in mind that when you invest in covered call ETFs, you're also diversifying the way in which you get your return. It's not just all about the price appreciation. That's just one form. If you're a value investor, you get it in the form of a lot of that is wrapped up in the share price and how that does. Some of it, a smaller portion, is in the quarterly dividends of various companies or ETFs. Then there are the income investors, where a good size of it, probably 50% of your, on average, return is coming through the distribution. So month over month, you are still getting that distribution where you don't have to sell off your portfolio to maybe support some form of cost of your living. You can hold on to your funds, ride the wave out, and potentially nothing happens. You're probably a lot more insulated with that form of your return than the other two variations that I've mentioned. So yes, things can go down. That certainly can affect covered call ETFs. Distributions can certainly drop. It just depends on how aggressive these strategies are. But at any rate, I mean, I haven't received all my distributions yet as of the making of this video for March, but I suspect that even despite all the uncertainty we've seen with the start of the Trump administration and the tariff stuff, my income's about to go up again. It's going to go up to probably $2,400 and I want to say $68, somewhere around there. I've done nothing different. I haven't contributed any more than I normally do. I've been doing $1,000 a month since the beginning of last year. So that's not about to change. And I'm happy just collecting the income, reinvest it in the beaten up stuff that's currently there, my various diversified funds. So I'm happy about it. Pick up some more shares, larger yields, and I just stay the course. That's it. Honestly, I'm not, this is something I'm not worried about whatsoever. And if something does change with something more kerosene is thrown on this, what may feel like a raging fire, unless something totally changes with the fundamentals or the objectives of the ETFs I invest in, then maybe that will warrant a change. But I don't see that in any of the all-in-one funds that I invest in. So hopefully that helps a summary of some of the biggest distribution changes, also the newest funds that have come out, and of course just my personal thoughts around the tariffs. If you like what you see, hit all the buttons of like and subscribe variety, and I'll see you all for the next series of videos, which will be all interview based. See you around.